thank you for having me. Really interesting agenda. Hopefully I can bring a unique perspective to the table here. And as Andy said, I sit in our investments area at Edward Jones. Part of my responsibility, though, is also building out the advice and product strategy around sustainable and ESG investing, which has really accelerated over the past few years. And maybe first, though, to kind of root us in maybe this perspective that I'm sharing with a little bit about Edward Jones. So Edward Jones, headquartered in St. Louis, I know as many of you know, one of the largest wealth management firms in the industry, and we're fortunate enough to be able to help guide and advise and manage 1.7 trillion in client assets in the U.S. and Canada, largely serving folks that rely on us and rely on our advice to help them meet their goals, individual investors. And it's something that we take very seriously and are humbled by. And so when I think about sustainable investing, from my vantage point, from our vantage point at Edward Jones, it's really from an investor's lens. So think clients and investors, asset managers that are investing in stocks, bonds, mutual funds, and really how they're increasingly looking to invest in a way that's much more socially conscious. And that we'll get into this, but that means very different things to a lot of different folks. And so again, that's the lens through which I'm looking at this. So questions like, what are shareholders and investors expecting? How is this driving corporate strategies in companies across all industries? Think about the earlier presentation and discussion around carbon emissions. What types of investments are investors looking for? How are regulators thinking about this topic, and how are firms like ours, more importantly, evolving to meet the needs of our clients? What advice and what products and services do they need to invest in a more socially conscious way? So really looking forward to the discussion. I have a few slides that I'll jump into, and then hopefully we'll have some time for Q&A. First, this is a space with many terms and definitions, no real industry standards. So one of the first things that we did a while back as we thought about how we would advise clients in the space is really get alignment on terms. What are we talking about? And we evaluated and debated and tested with our clients and advisors many different terms. So terms that many of you have heard: socially responsible, green investing, socially conscious, values-based investing, impact investing, and so on. Ultimately, we took a broad lens to this topic and have defined the broad umbrella as sustainable investing. And this is, at least in the asset and wealth management industry, really becoming the standard term to talk about how to invest in a socially conscious way. And so this, though, again, is the broad umbrella term. I won't go through all the details of our categorization and taxonomy, but there's two main buckets that we should talk about. One is environmental, social, and governance investing, or commonly referred to as ESG. And then values-based investing is the other big bucket. And so what do we mean by ESG? Self-explanatory, right? Incorporating environmental, social, and governance considerations into the investment process, along with traditional financial measures like valuation, corporate fundamentals. But it's really integrating ESG metrics right alongside traditional financial metrics. And so increasingly, looking at companies not only on the basis of, are they attractive investment from a risk return lens, but also, what are they exposed to? What risks do they have as it relates to climate change or their social profile, as well as the governance that they have set up, whether it's their board, its incentives, and what is the material risk that they may face based on those risks that they're exposed to. And it's also asking the question, many of our investors and asset managers are asking the question, should we allocate more to strong ESG companies, and should we divest from and invest less in companies that are exposed to material ESG risk? So what are a couple of examples, right? So ExxonMobil, what's their carbon footprint? What are they doing about it? How are they managing the potential transition in energy policy and how are they exposed to that risk? What is Nike's supply chain? What does that look like, and how are they managing workers' rights along that chain? What controversies could they be exposed to? And then a third example, maybe on the governance side, what does Google's executive compensation policy look like? How are they aligning that policy and those incentives to stakeholder and customer objectives like data privacy? So it's not only what risks are these companies exposed to, but it's also how well management is managing those risks as well. So the conversation today is going to be a little bit more focused on ESG. I think it's more relevant to the agenda today, but there is the second bucket, which we define as values-based investing. And that's really where client portfolios really start aligning with their personal values and can be implemented in a variety of ways, like targeting certain areas and stocks and industries, or excluding particular investments. So a couple of examples here would be faith-based investing. A big area of the market for portions of the country in the US that we serve. So investing in companies, for example, that align with Christian values or Sharia law, for example, or excluding companies that don't. And then, maybe from a different lens, security exclusions, excluding tobacco or firearm companies from your portfolio because of a moral viewpoint that you have around investing in those companies. And so, the line between ESG and values-based can get a little fuzzy, but the key distinction in our mind is that ESG is really focused on financial materiality related to ESG risks, where values-based is much more agnostic to financial performance and more focused on ensuring portfolios align with moral viewpoints and the views of the investors. So that's how we define the space. I know we spent a little bit of time on that, but terminology is confusing, and I think you can see why. So wanted to spend a couple minutes on that. Let me take this one step lower just to make sure we're on the same page with ESG, and then I'll zoom out a little bit and talk about why we are increasingly seeing demand in this space from our lens. Like I mentioned, ESG considerations are becoming table stakes and a key element on how the $50 trillion of investments in the US are being allocated. And there are many ways to look at ESG risk, but there's a lot of blossoming research, and there's a lot more standardization over the past few years than there's ever been around how you assess companies through a socially conscious and ESG lens. And to simplify, MSCI is one of the major providers, and that's why I use them as an example. It's a firm that we partner with. It's essentially looking at a company, what they disclose, asking management questions to get to a simple view of, are you a good ESG quality company or are you not? Do you have high ESG risk or do you not? Do you manage your ESG risks well or do you not? And there's, again, a good deal of work that goes on. MSCI, for example, has 200 research analysts to profile the thousands of companies in the US and globally to assess companies through this lens. And corporate America and global corporations are certainly responding. It's impacting corporate strategy, it's impacting disclosures, it's impacting questions management may be asking employees and leaders in their organization about the sustainable direction that these firms should take, whether that's manufacturing or operations. It's oil companies like ExxonMobil, or it's technology companies. And so really picking up steam. Why? Well, maybe before we get into why today, I'm not going to go through this timeline. This isn't a new topic. The point of this slide is, this whole notion of ESG investing, socially responsible investing, has been around for, let's call it 100 years. But the space has meaningfully evolved over the past decade, and it's accelerated, in our opinion, over the past 3 to 4 years. And the mindset has also shifted quite a bit in the space. It's less about being a do-gooder and an attitude around that, And it's much more about impact and financial risk and material financial risk in the short term and long term. And we believe, and we've looked at this, we've evaluated this over the past 10 to 15 years. We've never really amped up our advice and products in the space until recently, and why, and I'll get to the why in a second, but ultimately we believe that at this point, this has a lot of staying power in the industry, and is also something that we believe at least a portion of our clients expect out of us, to be able to advise them and have products available to them to invest in this way. And so again, regulatory environment has been a driver. That's been part of the reason why there's been an uptick in this demand and in this space, especially in Europe. Europe's definitely been ahead of the curve as it relates to ESG disclosure, requiring asset managers and asset owners to incorporate ESG as part of the investment evaluation process. The current presidential administration has certainly had a more supportive tone on this topic as well. Standardized research, like I just talked about, has helped. But I would argue the big why around why we believe this is an enduring theme and trend in the asset and wealth management industry is investor demand. I mean, client consumer expectations have evolved meaningfully, and that's been the biggest catalyst for the demand in the space. Morgan Stanley does a good study every 2 years, and I'll walk through these numbers in a second. They do a really good study profiling both institutional investors as well as individual investors, folks like you and me. And what they found most recently, this is the 2021 study, is that 99% of millennials are interested in leaning in the space, learning more, and investing more into this area of the market. And 79% broadly of individual investors are also interested in sustainable investing. To be clear, this is interest, this isn't action, but I'll get to this in a second. You're seeing a lot more action as of late to follow the interest. And when you think about the broader backdrop of the intergenerational wealth transfer, what do I mean by that? We have baby boomers nearing retirement or in retirement. You have millennials over the coming 10 to 20 years inheriting, let's call it $30 trillion of investments. There is a big shift that we would expect and increasing demand ultimately for ESG investments, ESG mutual funds and ETFs, and expectations again for firms like ours, firms like other asset managers, to invest in a socially conscious way. And you can see in the upper right-hand box, institutional asset owners, think pensions, endowments, 95% at this point are either have or are increasing their capabilities to invest through an ESG lens. And again, this is the standard in Europe with regulation. And so for many asset managers and global companies, it is expected out of them as well, whether they do business in the US as well or not. So that's the big why, in our opinion, is client expectations have changed. And you can see on this slide, assets are following. Here's one chart from BlackRock to bring this to life. One of the industry's largest asset managers, they manage $10 trillion in assets. They have also taken a big step forward in the sustainable investing space. And from their lens and their projections, this is a 15-year view. From their lens, they're expecting tremendous growth here, right? Almost to $2 trillion in assets from where we are today, which is a little bit below $1 trillion. That's projections. We generally directionally agree with the uptick in demand, but what you've seen looking backwards is a big increase in demand, especially in late 2019, with a lot more emphasis on climate change, carbon emissions, and then in 2022 with the social backdrop that the world experienced and certainly the US experienced, there was a lot more action taken in investing in socially conscious companies, high quality ESG companies. we expect that trend to continue. It's not just clients. From our lens, like I mentioned, we have 19,000 financial advisors that run their practice to serve their clients and help them meet their goals and objectives. And many are being asked about this topic from their clients. Many of them are being proactive with this topic and incorporating it as a key element of their value proposition to clients, is helping them invest in a more socially conscious way. I don't read all these quotes, but you look at the top box and you think about expanding beyond financial advice, really delivering value to clients. Sustainable investing has helped me get to more deeply know my clients and what truly matters most to them beyond their financial situation or monetary goals. That's transcending financial advice, and many financial advisors are really looking at this as a way to strengthen their practice and strengthen the relationship with their clients. And so increasingly becoming an expectation of financial advisors and table stakes for firms like ours to have advice and products available. I'll take us home here. One of the biggest hurdles in the past has been performance, right? Do I have to give up performance to do good with my investments? And I think that was generally the trade-off that you had to make when this was all about excluding areas of the market, tobacco stocks, sin stocks, oil companies, whatever it may be from your portfolio. Now that it's much more about financial materiality and ESG risks, our view has certainly changed, and we looked at this a number of different ways. Did our own research and analysis. There's plenty of academic studies and meta studies on this topic. We debated the fundamental merits of ESG risks, and ultimately our view, and this slide is a simple illustration of the fact that we believe ESG investing and incorporating ESG financial materiality into the evaluation process is essentially neutral on performance. It's an additional way to assess a company and the risks that they're exposed to, which ultimately, in our view, is roughly neutral on performance. And you can get into all the details around this, and happy to in the Q&A. But this is, you can see from this chart, a simplified output of the performance pattern of high quality ESG companies versus just a general index of all companies, pretty much in line over the past 15 or so years. So looking forward, you have strong investor demand, asset and wealth managers creating more advice and products to meet that demand. Performance isn't as big of a hangup as it once was. What are the key things that we're keeping an eye on? One is terminology. There are many regulatory and industry bodies that are trying to standardize how we define this space. It is still a challenge, and it's a challenge because of the second one, which is education and training. If we don't know exactly how to define the space, it's hard to educate and build the acumen of financial advisors. It's hard to build the acumen and educate and train clients and help them really understand what matters to them. Data will help with this, and data is definitely increasingly a commodity rather than a rarity that it once was. So that will help with more consistency, in our opinion. And then regulation, your guess is as good as mine of the ebb and flow of what's going to go on with public policy. But there is a lot of talk around standardization, more transparency and disclosure, and more consistent requirements for asset managers and wealth managers in the space, which should at least help to know what the playing field is and what the boundaries are, but we're just not there yet. So last slide. If I step out of the asset and wealth management industry and digest all of this, I think from all industries lens, sustainable investing is a key trend in the asset and wealth management industry. And why that matters is because the asset and wealth management industry asks a lot of questions about the companies that they invest in. And this is certainly shaping corporate strategy in all industries. Evolving client and consumer expectations, in our view, makes this less of a fad and more of an enduring theme in the industry. Not all clients want to invest in a socially conscious way, but there is there is a growing population of clients, both institutional and retail, that will expect this from companies. ESG disclosure and management will be table stakes. We're taking a hard look at ourselves at Everett Jones and our financial statements, the work that we are doing. We're turning 100 next year as an organization. We're taking a look at what the next 100 years will look like, and sustainability needs to be at the forefront of that. And so we're not alone in that endeavor. And then regulation and public policy, as I mentioned, could be a further catalyst for increasing focus on this topic.